Good afternoon, everyone, and thanks very much for being here and hopefully listening to a very enjoyable as well as informative discussion. As we've just heard, do feel free to send emails to Pigeonhole, and I shall endeavor to ask the questions that I'm seeing on my laptop here as part of that. So we will have a discussion first, and then we'll open it up to Q&A. First of all, I'll describe who I am, and then ask each panelist to also describe themselves, and then we'll jump straight in. My own background, Sassan, Danesh, managing partner of Fee Trading Software. We're a professional services technology firm, and we are focused on capital markets. We build digital utilities on behalf of capital markets participants. So a lot of what we do is look at creating streamlined, normally automated utilities that can be accessed to streamline and automate previously manual processes within capital markets. Our background, mostly over-the-counter, as opposed to exchange-driven, where there has historically been huge scope for automation. That's me. I think what I'll do is perhaps start right at the end with Danesh.
Good afternoon. My name is Danesh from Israel. So today I'm managing partner of OurCrowd, one of the leading VC fund, venture capital fund, and one of the world's leading equity crowdfunding platform. So prior to that, I was actually an entrepreneur. My last company was Pocket Guide. And you may ask why an entrepreneur would become an investor. It's really, in our space, it's a little bit joining the dark side. But I think we understood that there is a huge gap on the venture capital markets. Because there are, venture capital has really disrupted every single industry in the world. Also, it's done really well for the investors. But it's always been an exclusive club. It was only available for corporates, institutions, and men and women with hundreds of millions, if not billions of dollars. So I believe we have disrupted this business. Today we have, in 4.5 years, we invested $500 million in 120 companies with over 15 exits. And I'm very excited to be back here in Singapore. We just opened our office here. And I really believe that Asia is one of our most exciting markets.
Perfect.
Good afternoon. My name is Ramaswami. I work for the Singapore Exchange. We are the operators of the securities and the derivatives markets in Singapore, as well as the post-trade environments, including the depository. We are, I guess, by definition, the oldest of the FinTech firms on the platform here. Exchanges forever have been in technology in some way, shape, or form, and the progress in technology is a daily activity in exchanges. It's the speed of trading, it's the speed of information dissemination, the comprehensive nature of what we disseminate. So we are very much part of the financial industry as well as the technology industry. And I guess where these come together in FinTech, we certainly have a role to play, and we are big participants in that.
Yeah, good afternoon, Singapore. Very pleased to be part of the world's biggest FinTech event today. My name is Robert Lempka. I'm co-founder and CEO of Ayondo. We are a FinTech group offering trading and investment solutions to the retail customer, but also to businesses.
Oh, okay. That's very good. Kaidi.
Thanks. I'll start from the other side and from the history. Actually, I'm from Estonia, so I'm Estonian. I grew up in Estonia. I worked in Estonia, and also the startup I run is from Estonia. And I used to work as the first IT lawyer in Estonia for the Estonian government late 90s. So it introduced me to the technology and to the newest technologies. But then I joined the stock exchange, this Central Securities Board, and then the stock exchange. When I left, I was the CEO of the NASDAQ, of the local branch, and now the company Funderbeam which we're now working, is like a stock exchange of the startup companies, the global startup companies. So we help companies to raise the funds, and we trade with the investments. We built it on the blockchain technology, so it is interesting and challenging to step from one side of the industry to the other side.
Thank you all. I'm going to start by an observation which I'm sure everyone here has picked up, which is the diversity of the panel. And actually that's a reflection of the size of the capital markets. I mean, if you think about what you've just heard, on the one hand, we've got what are called primary markets, where it's to do with raising capital. You've got secondary markets, which is for the trading of that, and in particular, risk management. If we think about capital markets in the round, there are loads and loads of different asset classes, so equities, rates, credit, commodities, FX. All of these fall under this category of capital markets. And one observation that I'll make now is historically, the capital markets have been the preserve of the bigger institutions. And I think that's one of the areas that hopefully we'll touch on here in terms of what is technology doing to affect that. But before we move on, I'd like to get a little bit of audience participation. How familiar, put your hand up if you feel that in terms of what you've just heard, the terms that we've used and the concepts that have been used so far, are you familiar with it? How familiar are you with capital markets, I guess is the question. So up if you are. And let's just, so not bad, you know, probably half. How many are not? Put your hand up if you're not. Okay, not many are not, so lots of people not entirely sure, but half are. Good. Okay, that's something helpful for us as we move forward. What I want to do then is just talk about the key themes as the panelists see for this discussion. And before we came on, we were talking around so how has technology impacted capital markets? And we discussed transparency as a key area, democratization of access, as well as what we called evolution versus revolution. How much should change be gradual versus a disruptive step change? So those are the areas that we'll talk about here. And if you hear anything interesting, drop an email through to Pigeonhole and we'll pick it up and discuss further towards the end of the panel. But perhaps I can start with Robert. Talking about that concept of transparency and how technology can bring about more transparency. Certainly, regulators have been very keen on this word called transparency and how that in the capital markets is a good thing. Do you want to just start with your thoughts as to how is transparency being brought about and what do you mean by transparency?
Sure, thank you, Sassan. So, I guess you mentioned that transparency is in the heart of FinTech, what FinTech is about. I guess it's also one of the largest criticisms of the more traditional financial institutions not delivering enough transparency. And I guess that's also where regulators come in and try to change this and try to bring stricter rules to the market to make sure that financial products are distributed to the right people. It actually starts there, where how is the financial product displayed? Who is actually appropriate or suitable to use that financial product? And technology comes in at the very first moment. Right? So by actually signing up a customer these days, we use data analysis, real-time scoring models to actually identify straight away whether our customers should use our products or not. So that's where it starts. Then we move on to execution. Obviously, in a trading and investment business or in capital markets in general, this is absolutely key. Transparent, fast, and reliable execution. So maybe let me explain how we look at it and how it works with Ayondo. So we are running a concept, it's called social trading. which is a community-powered possibility for retail investors to replicate trading and investment strategies of market experts in real time, okay, and automatically. So by definition, there is a high degree, we depend to a high degree on technology, on fast and reliable technology. And how comes the transparency into that equation? So we look at how the traditional product would work. You would, if you're interested in buying a managed product, an actively managed financial product, you would maybe call your private banker or your financial advisor, and you would buy. You would have to invest probably several $100,000 of dollars in buying a hedge fund product or a managed account. So with us, you are actually empowered to do it yourself. You come into our community and everything, all the strategies are completely transparent. You can pick the manager, the money manager you want, and you can build your own managed fund.
So that transparency is also bringing control because of the extra knowledge that it's providing.
Absolutely, it brings control, it empowers the customer, and ultimately it gives more trust to the customer. And in the end, that's what we need. We need the customer the customer to trust us.
Perfect. Any other comments from the panelists?
I can jump in because I promised to comment everything what you said. The transparency game is a very simple game. It's like first you understand what game is played and who are the players. And it's the customers that need to understand what is this product and who provides you the product. And because of the historical reasons of how investment services are provided when we talk about the stock markets or where we talk about the investment funds or where we talk about any other ways how people can invest their money into the products, it's now we have very many intermediates in between the customer and the company who needs the money. And it's not just technology that makes it easier, but it's actually the whole game and the whole understanding from the customer point of view. Do I really understand what I use, and do I really understand who provides me the service? And when we talk about the service providers, it's we talk about the KYC, we talk about the AML, we talk about the reporting, we talk about the information disclosure. And definitely technology is there to help it. But again, because of the historical reasons, the chain and participants have been built into the regulations, then we're not just, technology doesn't help us, but also the regulators have to step in and say, okay, we don't need maybe these so many intermediaries because of the technology, we can do it so much more efficiently.
Very good. Any other comments?
I guess transparency is applied in many contexts. The simplest form is price transparency, where if you take the average bond, you don't know the price. You have to call up a bank or a broker and say, what would this bond cost? And if you take an average stock, you know the price because they're generally tickers which say at what price it is traded. And that was the most simple form of transparency. And individual ideas which take transparency to the next level, which say you would know what others who are experts have just now bought or sold and do that in real time. That takes transparency to a next level. And it's not just transparency of price anymore, it's transparency of momentum in the market and who's doing what in the market. And that doesn't exist today, and that's what this entity does.
So if I were to sum up some of what I've just heard, first of all, transparency actually applies at different levels within the cycle of the capital market. So we've talked about it at the raising of the funds level, so what I would call primary markets. And then in secondary markets, actually it's both at that pre-trade level where it's to do with pricing, but also post-trade, when after you've traded, who's traded, how much has been traded and where and so on. also, there's a link to regulations that came through loud and clear, and of course, capital markets these days, it's very difficult to say that word without also saying the word regulation. That's the fact of life. We all have to live with it. On that point of regulation, what I want to do is just explore perhaps a little bit in terms of is there a role for regulators to either promote transparency or to be involved in it in the discussion, or the alternative, given how much regulation there is no, please stay away. There's enough we've got to do. I don't know if the panel have any ideas on that.
Yeah, transparency plays a key role in minimizing the ignorance premium, right? So if you don't know what something is being sold for, you can offer up a price that is just based on your individual opinion, and that may or may not be right in that particular context. But if you're able to know what 10 experts have just done or 10 other lay people have just done, your guess is then based on, do you want to be higher than that or lower than that? So your reasoning becomes better. So I think regulators certainly have a role in minimizing any kind of premium you pay for any service. So here they have to minimize what I call the ignorance premium. And so to that extent, most regulations in capital markets promote transparency.
I've now seen different regulations, not just here in this space, but as I'm from Europe, and European regulation is a bit too detailed by now. And what we've learned during our journey is that too much regulation is never good, but too much means that actually the regulation goes into the details. And if the regulation goes into the details, then it might stop the innovation, even if we talk about the innovation in the transparency. And the role of the regulators is to see that the investors' rights are protected by giving them the right understanding what the product is, how we use the product, what are the risks in the products, and this is the role of the service providers. Now what kind of happened, and especially in the Europe, if you know this lovely word MiFID and MiFID II, then you know this is the outcome of maybe over-regulation, and we're not sure actually the customer rights and customer interest are best protected by this regulation.
Okay, food for thought. I want to pick up on one other aspect that you guys have talked about already or hinted at, and perhaps explore it further, which is the access to the market, and how really as part of that transparency, there's more people can now get hold of that. So if we pick that as a theme in terms of I guess the democratization of access to the capital markets for a broader community. I don't know if Danesh, you want to expand on that.
Sure.
And your thoughts.
So I think access is really, our core proposition to the venture capital market. So what is the issue on, again, I'm focusing on the venture capital market. There are two forces here, yeah? There are the startups, the entrepreneurs, the SMEs who need access to capital, yeah? And on the other side, we have this huge potential investor group who wants to have access to the venture capital asset class. As we discussed it a little bit earlier, venture capital has only been available to an exclusive club of investors, which were the corporates, the institutions, and the billionaires. And there is this asset class that everybody should, kind of, not everybody, but still, we are not fully democratized, because we still, you have to understand that many of the venture capital is still not for everyone, but there is still a mass market that wants to get into that asset class, and they can't, or they couldn't. So I think, that was the idea behind when we created OurCrowd, and as I mentioned, we are democratizing the venture capital investment, but still not fully democratized, because on both of these ends, the key is curation. Yeah, so we know that the private equity venture capital asset class is a high risk asset class. So the issue is what we see, by the way, globally, that they think that they can make this into a marketplace. And maybe marketplace works when you want to sell your iPhone, or you want to buy maybe a new tie, I don't wear a tie. But it's not going to work with venture capital. So we need to curate the companies. So for example, in our business model, we look at 200, 250 companies a month, and we invest in 2. So from 100 deals, we throw 99 away. And sometimes we do diligence for 6 to 12 months before we bring it to the platform. Then we share transparency, we share all the information to the investor, whether you're a corporate like GE, or whether you're a big family office, or whether you're an accredited investor. And then you can pick the deal that you like, and with all the information. But again, we curate the investors. We don't let everybody, because again, we don't want, I'm sorry to use the term, moms and pops, to invest in an asset class where they don't understand the risk they take. So I think access is all about, it's all about access.
Any other comments?
Yeah, access has always been the key, right? Which is, if you have $1 million to invest, you can go into a venture fund yourself. But if you had $5,000, you generally could not. And so it's just brought down what I would call the minimum investable quantity before which you can get into a particular asset class or a risk-reward profile. And if you go back in time, that's what stock markets did initially, which was, if you had a bright idea and started a company and that did well, if you needed a lot of money to expand, you may not have had the money, but you could open this up to entire investing public, who would all then own a common stock with just $10 a share or $2 a share or whatever was the price. And the promoter of the venture did have the capital then to grow or invest further in his business. So I think taking that to more and more inaccessible asset classes now is the next challenge. And I think that in today's world, what's happening is, with the amount of private equity and private wealth that is around, the number of institutions that come to the public markets for financing is begun to drop. For the first year, in the last year, I think there was less public markets capital raised than there was in private markets. And therefore, efforts like what you just talked about become very critical to ensure that the vast majority of us who are investors don't get locked out of those markets. So I think what is happening here is application of an old idea, but into a new context and in what is today's, I would say, areas of interest, as well as areas where we have challenges to overcome.
So I guess I would like to add to that. I think technology has helped to make products more accessible to customers, mainly also from the point of affordability. So I think that in the heart of FinTech is that they quite often have a very sector-specific proposition, and therefore they can deliver products much cheaper and in a much more efficient way. And here technology obviously has helped emergence of secure internet, smartphone, and so on. One point Dennis mentioned earlier on is still not fully democratized, because I think that a lot of people actually are not educated enough to use certain products. Okay, and I think here technology is playing an increasing role in having, data analysis about the customers, and offering them educational programs via the internet, via smartphones, things which haven't been possible maybe 5 to 10 years ago. So I think actually technology helps here to widen the spectrum of potential investors, and therefore contributing significantly to the democratization.
Yeah, also, do you agree, and maybe stepping forward is, when we look at the wealth in the world, and the wealth actually on the personal level, then the wealth for us, it's not, and the human beings, it's not created by the daily jobs, but it's about getting access to the assets. And the platforms that enable investing into either the real estate or the startups or the SMEs, it's about giving access to the assets. And because of technology, the access can reach to people and directly also to the customers. The question is, how do we explain to the customers what do they get and what are the assets? And here the service providers have a great role to do. And in our case, Funderbeam case, besides, we're not just enabling investors to invest into the startups, right? But we also enable them to trade. And can you imagine that the retail investors get access to this kind of a trading engine, which is normally seen by the brokers? So it's a challenge for us as a service provider to explain the retail investors how to sell, how to buy, what is a selling order, what is a, we even had to change the names bid and ask. And they see the full depth of the market, and they see the previous prices. And because of the nice and very easy to use user interface, we can do it and we can explain it. And if I compare the investors now in Funderbeam platform trading, and if I compare the investors when I was heading the stock exchange, then less mistakes are done by now, even though the orders were passed through the brokers, because people didn't understand those different pricing and what button to press. So this is what the technology can do. Technology can do a lot of education to enable still access to the investments and to really elaborate this word democratizing into the real life. Well,
I'm very interested in the discussion we just had, because if I were to sum up, I'd say that democratization, the discussion we've had here, is around moving from high cost, high touch scenarios to lower cost, lower touch, and enabling that through technology. And as part of doing that, that's not sufficient. It's also then informing the people who want to leverage that lower touch, lower cost model, giving them the information, empowering them in a way to then allow them to actually make the right decisions. Fascinating stuff. I'm going to move on to the third point and put it like this. So everything we've just discussed, both in terms of transparency and in terms of democratization of access, can be done in an evolutionary manner or a revolutionary manner. So effectively, a step change, which can be very disruptive and bring this kind of world around, or building on what's already there and investing and tweaking and just improving. So I want to get a sense from the panelists as to which one do you feel the focus should be on, and generally, which one will work better? And perhaps, Ramo, you'd like to start first.
You know, I would hypothesize that individual ideas have to be revolutionary, but in aggregate, change is always evolutionary. So to kind of make a point, if you take the fact that retail investors can today participate in private equity-like investments through an entity like this, that's a revolutionary idea in the context of private equity or in the context of participation in private equity type investments. However, it is evolutionary in a total capital market context, that it is not something that is going to change the entire capital markets. It changes a portion at a time. So I think the most progress is made by looking at ideas that worked in one context and applying it to 5 other contexts that today suffer from the lack of a similar capability. So I think the speed at which you do it is what will decide success for various, platforms. And technology helps the speed of implementation. So that's kind of how I see it. You can take an idea that is revolutionary for a particular context, implement it with great speed because of today's technology and the capabilities that it provides us. But on the whole, it helps, evolve the capital markets forward.
Okay. A mixture of both. Any other comments?
Yeah, I think the business process, so to say, is very, very important in this context. So we, for example, we use off-the-shelf technology. So we haven't invented any technology. We don't hold any patents, but the concept as such is revolutionary. Okay, the technology we're using is off the shelf. The concept is revolutionary. how you put it together, how you bring your knowledge in, how you develop your IP. So there's a coexistence between evolution and revolution.
The problem is ancient. Problem is someone has the money, someone needs the money, and those two parties need to meet. And there's someone in between. Right now, sort of quite many people or intermediates in between, but that's the thing. The revolution, I think, would be that when companies like Funderbeam stand up and look at Ramo writes SGX and say, you know what, we're going to put you out of the business. So it's the shift of the power. The evolution is more like we work together. And we really use and elaborate the technologies, and not just the technologies, but kind of new businesses, a new way of sharing economies and whatever the technology brings to us, work together and bring the change in the market. I don't know what's going to be and what's more effective. When I think about the revolutions in France, for example, the late 19th century, one power was shifted by the other power. Would there be anything different if they work together? I don't know. But let's see how it goes in the future. But it feels to me that evolution is the path, it seems, that the industry has been taking. Because when I see the existing very strong financial corporations working with the startups, elaborating new technology, elaborating the new ways how we can democratize the investment, that sort of seems to be the route.
So I think evolution versus revolution, the answer is both. So there are industries where we've seen it was revolution. And by the way, if you look back in history in the world, very few revolutions really work. So I don't know how many of you still rent videos through Blockbuster. I mean, I assume none of you. Netflix and other players totally revolutionized the market, and it's disappeared. Also, how many people buy CDs still in retail shops? There is iTunes, and I think we will see many industries which are going to be totally revolutionized. I mean, autonomous driving, I think it's going to probably happen. The question is it 5 years or 10 years? Now, FinTech is very interesting, because FinTech, I don't think there's going to be full revolution. Because there are here key, if I really simplify it, there are key players here. Yeah? On one side, we have the FinTech disruptors, the innovators. And on the other end of the spectrum, we have the incumbents, the banks, the big financial institutions. And actually, both need each other. What the innovators bring, the digital expertise, the customer experience, price points, but they need scale, they need customer acquisition, they need trust and reputation that they don't have, and it's very difficult to acquire. Who has that? The financial institutions. But what they don't have is often what the innovators bring. So I think there's a lot of courting is going on there between the two, and there is a huge potential there for marriage. Very few will work out, but I mean we have an amazing relationship with UOB, the bank, and they have really kind of try to we see the evolution, how they do it, because instead of, like, they want to get into these early stage companies, and they understand that that's not their core strength. So instead, they partner up for each of those areas with different players. And by that, they don't lose the SMEs. They get very early on. We see that how they understood that instead of being disrupted, let's disrupt ourselves.
So perhaps a marriage of the two. I don't know if, Kaidi, if you want to say the last word on this, and then we'll flip over to Q&A.
All right. I was just, what you said lately, isn't it because it's the most regulated sector, what we are, we can't revolutionize it because it's so heavily regulated. You have to operate under the existing regulations. And those, what you mentioned about autonomous cars and Netflix and stuff, they're so less regulated industries that you actually can go there and shift the business model so rapidly and so fast.
100%, and by the way, we see it, but many of these FinTech innovations, they're under the regulatory radar. And once they become big enough, then is an issue. And again, here they need the banks or the financial institutions because they know how to deal with the regulation. I mean, you see with Uber, until they were a small player, nobody cares about it. Now they hit, problems almost, all over the world with the regulators.
Okay, Dennis, you have the last word. Right, I'm moving on. Let me see if I can get this pigeonhole working. Hopefully something will pop up. But in the meantime, I'm going to read the question. And actually, it's for Kaidi and Ramu. Will blockchain technology eliminate the need of an exchange? And of course, Kaidi, I'm aware that you were literally just a minute ago saying, there's something in the middle. But the question is, should there be, or can there be something not in the middle?
The blockchain, everybody says about blockchain is about the decentralization and it enables, because of the technology, access to the investments without the intermediates. But the funny thing, the first thing what was built after the cryptocurrencies are introduced and the blockchain got in full use is the cryptocurrency exchanges. So the first intermediate that was there was the exchange. And I think the same thing happens with the exchanges when we talk about the trading securities, is that still there is an element of centralization. And because of the blockchain technology, it's not so much about trading, it's about the post-trading, anything that happens, securing that my assets belong to you and your funds do belong to me. So I think the exchanges still have the role, because of the transparency,
Yeah. Ramu?
Yeah, same here. I do think exchanges will continue to have a role. If you take the cost of trading, there are three elements to it, right? The first is the price discovery, and then the ability to do a transaction. And the last step, which is the most important, is to then actually get the share you bought for the money you're parting with, or to ensure that there's finality and certainty about the settlement. So if you take all these three roles that an exchange broadly plays today, I think those roles will continue to exist. A blockchain could make it cheaper for an exchange to do it, or it could make it cheaper for whoever is the provider to do that in the long run. But there will still be the need for these things, a price discovery, an ability to do a trade, and then a guarantee or a surety that you're going to get what you bought, or you're going to get the value that you think you have contracted to get. So I think those things don't go away. And so whether it's blockchain or whether it is a ledger which used to be manually written 20 years ago, today it's kind of in a big database. In the future it could be in a blockchain, but those things are merely the artifacts in which they are stored. And these roles I don't think will disappear.
So, okay, perhaps it won't go away too quickly. I'm fascinated by the idea that if this were to be possible, how a decentralized world will cope with the regulatory requirements that are out there today, which today the exchanges bear the brunt of. And if it were to be decentralized, does each individual person then take those responsibilities? But that's for a future date. Okay, I'm going to move on to the second question, which is an interesting one. Will the panelists trade highly speculative cryptocurrencies, particularly bitcoins? I'll throw this up. Yes, so I'll repeat the question. The question is, will the panelists trade highly speculative cryptocurrencies, particularly bitcoins? So I'm assuming this is...
If shorting also is then maybe yes.
Yeah, as an exchange operator, would I offer that up for trading? Probably not. But as an individual, would I put 5% of my money into a speculative bet? Yes.
Yeah, and depends on what's the purpose of the trading. If it's the learning, definitely. You have to learn and go and test and see how the system works.
Yeah, I would invite people to join our platform, because there you can actually watch professionals doing this. Yeah. And you can learn from them, and then you can follow them, so you can reduce your risk doing this.
Perfect. Okay, well, that's good. So we have pretty much consensus to actually go for it. I must say, well, you learn by failing sometimes as well. So, and talking about potentially failing, the third question: how do you think ICOs will impact the primary markets and exchanges?
Well, you know, an ICO is no different than a security offering in an IPO kind of context. The rules for an IPO are reasonably clear. For an ICO, they're not yet that clear. And an ICO is merely an offer to join entrepreneur or whoever is the promoter to mine for bitcoins or mine for cryptocurrencies. So what you get out of that mine, you know, is when you invest in a gold mine, you don't get gold out of that mine that you will get as an investor. You probably get a dividend, which is, you know, in dollars or in whatever currency you invested in. So similarly here, you could get a dividend in a currency you invest in, or you could get the cryptocurrency itself as a dividend. All those are still evolving, and I don't think there is one particular standard that anyone's following for an ICO. And that's what gives rise to concerns around ICOs and the fact that people are not well enough educated on them, and you could get burnt thinking you're going to get a Bitcoin when you invest, whereas you might just get a few cents as a dividend.
So I'm just going to throw in a second question related to this, and as panelists, as you're answering this, perhaps you can think about the second question as well, which is, will the ICO bubble burst? What's your prediction? So throw that into the mix as you're answering the question around use of ICOs.
So someone said very nicely is that the technology, blockchain and Ethereum technology specifically, has given an opportunity to every single company print their own money. And to track their own money. Now, if you invest, the question is, what kind of money do you get, right? Is it going to be a US dollar or some other dollar or a very good Singaporean dollar? Now, what has happened is that actually the real meaning of the ICO is about enabling to invest into technology and enabling to start contributing into building the blockchain. But what has happened is maybe the other side of the coin is that companies have started to raise the funds and not even thinking about building the technology or enabling investors to invest into the protocol. And because of industry has been sort of misused the opportunity of the ICOs, regulators have stepped in much faster than they have, and maybe next year, someone said so nicely, is that it's going to be the year of the court cases, because we've already seen that the first things have happened. So I predict that next year is going to be a very, very interesting year when we talk about the ICOs.
Yeah, things like a party, you know, one day you have a party, next morning you regret it, you have a hangover, and then off to the next party after you recovered. And that's a little bit how these markets sometimes work. You know, there's an extreme hype in this market, and therefore people are, you know, maybe not looking at the details, don't fully understand. It's just a sense of, well, these things go up anyway, so let's put some money in. So I think that will change. It will be a much more controlled process and a much more informed process.
But definitely what the ICOs will do for the capital market, or capital markets and for the stock exchanges, it will force all the market participants to be much more efficient, much more efficient.
I must admit, my own observation here is something a little bit on the side, which is that there are $11 trillion worth of negative yielding assets out there, and whether, if that situation were ever to change, whether that would have an impact on the ICO markets. We shall see.
You know, there's a saying that in every gold rush, it's only the pickaxe maker who makes the money, right? So here I would say go buy some server makers, and, you know, as you invest in the ICOs, also buy stocks of people who make servers that help this mining.
Perfect. Okay, I'm going to move on to the next question, which is, well, I'll read the question. Blockchain, AI, and big data seem to affect only trade settlement, payments, and research. Is there any other application in capital markets that the panel feels that these developments can have? So effectively, the way I would paraphrase that, the new technologies seem to be focused on payments as well as the trading and research. Any other areas do you feel that might be impacted? I'm struggling.
Is it about the FinTech overall, or is it about the capital markets?
Well, I think we have license to interpret the question. So the question, I think, was around capital markets, but I think if you feel that on the FinTech side...
Yeah, I mean, when we talk about the AI and artificial intelligence, what it brings, it brings robots on the streets, and it brings, as recently we've discovered, is that there's a robot cooking omelette every morning. But if something happens with the omelette and something happens with the person who eats the omelette, then who's going to take the blame? And then it comes to the InsurTech, and then it comes to the different areas where robots do something for the humans. Either they give the investment advice, or they serve you, the bots, the chatbots, right, who serve you as a customer. Then who takes the implications? And that's maybe something that's coming to the FinTech, and especially the InsurTech.
Well, that's a very good point, and actually it is related to a question that has also just come through around whether traditional fund management will become extinct if the incremental costs of acquiring and incorporating information into alpha ideas is replaced by cheap data and AI. So obviously there's a trend generally towards more passive anyway, and perhaps smart beta, as it might be called as well, and then more and more, why not alpha as well? Any comments by the panelists?
No, I think that's a cycle. I think that a stock picking fund manager who does better than the index is kind of where the world was maybe 10 years ago. And rather than pay a fee for that, you felt that you could just buy an ETF which mimics the whole market, and you're doing almost as well. So the pendulum is swinging where an enormous portion of the market today is just tracking the index. And you're not paying for alpha, you're kind of not paying anyone to pick stocks. So when the whole market goes like this, again, there will be stocks which do better than the market. And then it's all about size. You can pick 5% of the market that's doing much better, and so it'll be back to fund managers who do that. So I don't think that this will ever have an equilibrium which says, index funds are better or alpha seeking is better. I think it'll keep swinging, being in the right cycle, or, and one of the things there is the less informed you are, the more likely that you're always in the wrong part of that pendulum. And that's where new technology can help influence people in terms of being at least in the right part of that cycle.
So I think I'm trying to, this is more a question to you guys, because we are really in the venture capital market and this is more for the public markets. And I think the beauty, we're using as much as we can AI, big data, machine learning, but in our industry, it's still such a human business. And I think it's one of the last businesses where human interaction will stay, alive much longer, because, in real estate, it's location, location, location. In the venture capital business, it's people, people, people. So, and that is very, very difficult to kind of substitute with big data. Certain things you can, but it's all about, we invest in people. The rest is a calculated business risk. But when it's early stage investing, it's very little that we love it. We invest in AI companies and machine learning and big data companies. But again, our business is, I don't think it will take time until it's, and I don't know if it can be fully revolutionized or fully disrupted.
I guess the question there being how easy is it to have objective metrics around, for example, quality of the management and so on, or the quality of the business plan and so on and so forth. I'm conscious of time. We have 18 seconds and counting. I suspect we can go over a little bit. Well, I'd like to do one thing, which is, if there's one key takeaway for the audience, what would it be? And perhaps if, Kaidi, if you start and then perhaps go round.
I think that the technology actually enables us to do much more than we can do here in the financial sector industry, and especially in Funderbeam case, we talk about the trading and investing globally. And it's now the competition not going between the companies, but the competition is going between the regulators. And whose regulator, and which country's regulator is the most innovative, this country will become the booming hub for the FinTech and next-gen companies. So actually challenging all the regulators to actually think out of the box and think for the future.
I like that. The point is, of course, hopefully we have some regulators in the audience who will take something away as well. Robert.
I would like to touch maybe on the point of evolution and collaboration. I think it's a big takeaway for a lot of people here, probably a lot of FinTech entrepreneurs in here. FinTech has got its advantages, FinTech has got its challenges, and one is scaling, one is scaling the customer base. And I think what my advice maybe as a takeaway for people would be to look really into collaboration and leverage the specific knowledge and the specific IP to scale up with more traditional institutions.
Perfect. Ramo?
The fundamentals of the capital markets don't change. It is any company that delivers well will do well. So the key is how to use all these new tools and technologies to help you, separate the wheat from the chaff or invest in the ones that are going to be the winners. So I think that's where one's got to focus on. And these are all a means to an end, and the end is to do better in your investment. So therefore, any new technology is nothing more than a tool to get you there.
So I was here last year, and it's just unbelievable to see what happened just in a year. I mean, this conference is really amazing. And I think we see all these innovations and innovators and entrepreneurs. And coming from Israel, something that we wanted to share with the world is like taking risks. And I think the key message for the entrepreneur spirit here is just don't be afraid of failure. It's okay. It's in our business. It's totally acceptable, and educate the investors and educate yourselves that failing is okay. And the only way to get to a success is you have to fail again, and then the success comes. So it's not a binary game.
Perfect. A bit like the inspiration-perspiration ratio. Perfect. Well, I hope that's been very interesting for the audience. The only thing left really is for me to thank the panelists for your insights and explanations. Thank you very much.